Okay, so today is day 2 of the boot camp, right? So yesterday, what did we discuss? Yesterday we discussed the foundations of all price movements, right? We understand that there's a sort of a cycle, as one might say, because price is algorithmic, right? Because price is algorithmic, it has a cycle whereby you have your consolidation, then you have your expansion, okay? Expansion, reversal, or retracement. Yeah, reversal, retracement. Then you have what? Retracement, reversal. All right, retracement, reversal, and back to consolidation, right? For a new cycle to begin, right? For a new cycle to begin. So this is the algorithmic cycles that go through on a that price goes through on every time frame, right? So every time you have one cycle, you got to wait for the next cycle. And while you can profit off of each phase, okay, you're not necessarily going to get that same or similar pip count inside of each phase, right? So again, depending on the time frame. So if it's like a 1 hour thing, obviously you're going to have to wait for like, hours and hours, or maybe even a day or two before you can catch any one of these, right? So you will definitely have some losing trades over here, okay, inside the consolidation part. You will definitely have some losing trades, and then if you get the order flow wrong, you're going to have a loss here. Okay, now obviously once you lose over here, the order flow is obvious, right? The order flow is obvious. So from here onwards you can profit. Okay, from here onwards you can profit. Okay, now that is of course related to high resistance liquidity runs and low resistance liquidity runs, as we discussed yesterday. All right, now for price to actually move, right? For price to actually move, we understand, right? We understand that we have ICTs, PDA matrix, right? PDA matrix. Now, as ICT has explained, okay, as ICT has explained, the first guy in the PDA matrix is the what? Mitigation block. Okay, is the mitigation block. Then the second guy is what? Someone help me out. Second guy is breaker, right? So we have the breaker block. Now, if you look at the mitigation block and the breaker block, in terms of liquidity, okay, in terms of liquidity, what's the mitigation block? Is it high resistance or low resistance? Above, below the highs and lows, is it a low resistance liquidity pool or a high resistance liquidity pool? Low, right? So we have low resistance liquidity. Okay, so we have low resistance liquidity. Then obviously for the breaker block, we have high resistance liquidity, right? So high resistance liquidity. Cool. So now these two rather, okay, these two are the building blocks, right? For literally any price movement. Okay, if you're looking at a chart, for example, if you are looking at, let's say, a daily chart, and you're looking at daily down close candle, right? A daily down close candle, and then the up move immediately after it, it's going to have a mitigation block signature or a breaker block signature. What I'm saying is, it will either look like this, okay? So you have your down close here, and then you have your up close here, okay? So you're going to have this with a high resistance signature, all right? Or you're going to have this over here, right here, okay, with a what? Low resistance signature in price, all right? Low resistance signature in price, meaning that which low, okay, which low is more likely to get taken out? Is it going to be low A or low B? Is it going to be this one or this one? This one or this one? A or B? B is more likely, yeah, correct. B is more likely to get taken out, right? Because why? Because it's low resistance in nature. Okay, good. Then we take this out. Then the next part of the PDRA matrix is what? Someone help me. Next part of the PDRA matrix is ICT 5. Because the drawing over here looks at it like a 5. I don't know. Okay, the ICT, whatever. Okay. Number 3 is what? Liquidity void, right? So we have the liquidity void. All right. So we have the liquidity void. Then number 4, we have the fair value gap. Number 5, what do we have? We have what? Order block, right? Order block. Number 6, we have rejection block. And number 7, we have the liquidity pools or high or lows, right? Okay. Now, here's what you are going to be focusing on majority of the time in terms of, in terms of actively looking at price action. All right. You want to be focusing on number 1, number 2, number 5. Okay. So you want to be focusing on mitigation blocks, breaker blocks, and order blocks. Okay. Order blocks. Now, essentially speaking, okay, order blocks, right, are condensed versions of breakers and mitigation blocks. Okay, they are condensed versions of breaker blocks and mitigation blocks, which is why in ICT's mentorship, the majority of the PDRA matrix, okay, is called what? Under what title? Reinforcing what? Reinforcing. Someone help me out. Reinforcing order block theory, right? Reinforcing order block theory, which is why, not which is why, which means that if majority of the PDRA matrix, okay, is based on order blocks and how they look like on various time frames, okay, and how they look like on various time frames. Now, this entire part over here, I'm expecting everyone to know. All right. So now, when we look at these 3 only, okay, we have the 5-minute chart. We have the, let's say, 1 hour chart, and we have the daily. Okay, we have the daily. Now, on the 5-minute chart, if we take a bullish example of a breaker, right? So we have a low, and then we break up, and we come down, right? Break up and come down. Let me draw that a bit nicely. So we have this one up and down. Okay, so we have the low, and then higher low. Okay, so this is your breaker from here. Now notice it's this particular portion of price. All right. Now this particular portion of price, right? If you break it down, it's what? It's a series of down close candles, right? Or it's a down move. So what does a down move constitute? It constitutes of down close candles. So you have this, and that, right? You have this, and that. Followed by a move up like this, which is your bullish candle. Okay, and then price comes back down into the breaker, right? So we have another candle over here, comes back down into the breaker, and what? And it rejects from this particular portion of price over here, and then it continues to go up. Okay, it continues to go up. Now think about this. If this is a series of down close candles, okay, on the 5-minute, on the 1 hour, what are these series of down close candles going to be represented as? Someone tell. What are these series of down close candles going to be represented as? One big what? One big bullish order block, right? So one big bullish order block, correct. So knowing that it's one big bullish order block, okay, then on the 1 hour chart, you're going to just be seeing this. Down, oops, down, up. That's all. So now this down up move, okay, so down up. This down up move is equivalent to this. Okay, so it's your green and your dark blue scan here. All right, so dark blue scan. This is your order block, and this order block broken down to the 5-minute chart is equivalent to a bullish breaker. All right, this is equivalent to a bullish breaker with the high resistance signature in price. All right, with your high resistance signature in price. You got that? Now, we spoke about bullish breakers. Okay, we spoke about bullish breakers. Now, what about mitigation blocks? Let's look at mitigation blocks. Okay, so when we look at mitigation blocks, now let's look at the, now forget about the 5-minute. Let's look at the 1 hour. Okay, on the 1 hour, let's say you have now, okay, you have price going down. Okay, now it fails to go lower and then it breaks up like that. Okay, breaks up like that, and then it goes up. Okay, it goes up. So now if it goes up like that, we understand that, okay, we have a low, higher low, and then another higher low, followed by low, high, and a higher high, right? So here's the thing. This signature in price on the 1 hour chart, right? This signature in price on the 1 hour chart is going to look like something like this on the daily chart. All right. Is my pen the correct pen? Yeah. Okay. Daily chart, right? So now let's say the previous day you had an up move. Okay. Then the next day you had a down move. All right. And then the following day you have this. Right now, the color of course the color is important, right? The color is important. So you have the down close candle, and then you have the up close candle. All right, you have the up close candle. So what it's saying is, now if you look at the lows are going upward. So this is essentially like a trend line scenario, right? So whenever we have a trend line scenario, you have this scenario is a mitigation block, right? Question mark, question mark. Damn, y'all are having a whole ass conversation there. Okay, yes, it's a mitigation block, right? So you have a mitigation block over here, or it's a mitigation block scenario, right? Or a signature of the mitigation block. So now on the daily chart, you can see, you compare these lows, right? When you compare these lows, okay, when you compare these lows, obviously you can see that it is a low resistance liquidity run signature, meaning that once price goes up and does something, right, and when it's coming back down, if the narrative is correct, it will directly take out these lows. Okay, it will directly take out these lows. But now the most important thing that you need to be thinking about, okay, the most important thing that you need to be thinking about when you are faced with looking at candles, right, without needing to go down to the 1 minute, 5 minute, right? Simply all you can do is compare the lows of the down close candle prior to the up move. All right. If you have a down close candle doing this, giving you a high resistance liquidity run, you understand that fine, we have a lower time frame breaker scenario. So if it's a lower time frame breaker scenario, on the higher time frame, it's a return to a bullish order block. Okay, return to a bullish order block. That's how it looks like on the higher time frame. So on the lower time frame, we understand that, okay, we have a low, we have a low, and then we break above. That's giving us our bullish breaker. Then if we go to the higher time frame, we see that it's one big bullish order block. All right. Okay, is everyone with me? Feel me, you feel me, you feel me, okay. You guys are good, right? What context would price take out the low resistance liquidity on signature below the mitigation block? After, oh, actually, that's the context for that will be given next Sunday. That's the one where you can catch trades out of anywhere. So I'll give you that next Sunday. For now, we'll just stick to the basics. Okay. Okay. So you guys get it, right? The rest. Yeah. Okay. Cool, cool, cool. Right. So to summarize that part, okay, to summarize that part, you have the lower time frame, you have the higher time frame. Lower time frame, you have breaker. High time frame, you have just a simple move like this. Okay. This is your down close candle. This is your uh, institution in this is called it displacement. I can't pronounce that. This is your displacement. Okay. This is your displacement. Simple as that. So that's the breaker scenario. So you have a high resistance signature in price. All right. Then the last part would be the mitigation block, where you have okay, and on the higher time frame, it's going to look like something like this. So I'll draw a candlestick for you. So you have something like so low resistance liquidity run signature black 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 on green green green. That's how it looks like, right? So this is how I simplify the candlestick portion of it, right? In terms of determining bullish short blocks, bearish short blocks, the ones that are high probability and the ones that are low probability. So obviously now, without me having to tell you what is high probability and low probability, you understand that, okay? You understand that an order block that has a high resistance liquidity run signature is much more high probability, right? So an order block and oh, okay, an order block that is high resistance liquidity, right, is a better order block than one with a low resistance liquidity signature. Do you agree with me? Yes. Cool. Right. Now, here's the most important thing to consider. Okay. Here's the most important thing to consider. Now, without me telling it to you guys, can someone tell me? Okay. Can someone tell me the definition? Okay. So let me just write it down. The definition of a bullish order block. Okay, what's the definition of a bullish order block? Someone type it down. I want to see if you're right. Okay, so Theo made an attempt. Theo is wrong. Small kid made an attempt. Small kid got the first part right, but where's the second part? So small kid is partially right. So you only have this part. Michael got this. All right. No. I want the conceptual answer, not the practical answer. Wow, Michael Gibbons went and referred to his notes and came back and copied and pasted. Wow, okay. Michael Gibbons is right. Okay. All right. So the definition of an order block, right? Normally, the definition of an order block normally is basically a bullish order block rather is the lowest. Oh, where's my pen? Okay, is the lowest down close in a defined candle in a defined range with a healthy and moderately, or just say with a healthy body. Okay, with a healthy body. All right. Lowest down close candle in a defined range with a healthy body. So that is the ideal bullish order block. Okay, it's the ideal bullish order block. So what does that mean? It means that when you have a range, okay, when you have a range, and let's say you have all of this price action here, okay, and you obviously you're going to have down close candles here, 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 here. So the one that's actually going to be the correct one is the one over here. Okay, the lowest down close candle with a nice body. Okay, lowest down close candle with a nice body. So every down candle is a bullish opener. Okay, you need to have it correct. Sorry, you need to get the scenario and all that right. Okay, so that is your bullish order block. So now, given that we got the definition of the bullish order block right, now, except Michael, except Michael, what's someone give a definition of a bearish one? Bearish order block. Let's see. Damn, Theo with the copy and paste, switching lowest with the highest. Shoo. And switching support with resistance. Okay. All right. I need to do it. I don't know how to do it, right? So okay, so you guys get the point. All right, so you guys get the point, right? So it's the highest up close candle in a range with a nice body. Okay. Now, when you look at the variations, right? So now obviously you understand that we have one candle that looks like this. So here, here, and let's look at the high probability scenarios only. So we have that. Okay, so this is your bullish order block scenario. Okay, you have a bullish order block scenario, and then you have the other side, bearish order block. So bearish order block with this. Okay, so I got my colors mixed up. Okay, so green here, and then you have black here, bearish. Okay, right. So you have this and you have that. So as you can see, both are high probability, right? Here, here. Now, given that they're high probability, okay, sometimes you're going to be faced with scenarios, right? Sometimes you're going to be faced with scenarios whereby your bullish order block is going to look like this. Okay, you're going to be faced with scenarios like this. So now, when you are faced with scenarios like this, right? What I do, okay, what I do is I tend I tend to use the high of the wick to the body. Okay, high of the wick to the body with my mean threshold here, with of the wick. Mean threshold being the wick. All right. This is how I don't ask me why. I just do it. Okay, so you have the high, you have the mean threshold. So it's called the high, have the mean threshold, and you have the open. Sorry, close. Okay, closing price, the 50%, and or is it the opening price? Sorry, guys, it's the opening price. Okay, opening price 50% and the high. Okay, high 50% opening price. That is what I do. Okay, I know I have two ways of doing it. I use the high 50% and the open. Otherwise, what I do is I refer back and look for another down close candle that has more body. So I look at the next best thing. Okay, I look at the next best thing, and it will only be valid, right, as long as the context is valid. Essentially, as long as you have bullish order flow. And what is bullish order flow? What is bullish order flow shown as? SMT with a correlated asset pair, right? SMT with a correlated asset pair. So that is one of the extreme cases, in terms of when will I find it hard to, identify bullish order blocks. I use the high 50% opening price, right? Or I use the next best thing to the left. All right. Now the same can be said for the other guy, which is the bearish order block. Now the bearish order block, obviously the same thing reversed. So we draw it for you here. Okay, so we have this one, the small one here, boom, big wick. Okay, and you have the down close here, you have the up close over here. And now let's say I incorporate the other scenario as well, where I have another candle like this. Okay, so here's what I would do. We have in this case, this is the opening price. So opening price here, your 50% is here, and your low is here, right? So I would be interested in price from here to here. Okay, so this is my area of interest to sell from. Okay, to sell from. Now obviously you will have to choose between this one and this one. I'd say choose anything. So you to choose any one of these two, right? But now you have to look at what is the most highest in terms of probability, right? Now obviously the one I drew over here, this is the order block, not this one, but you have to think about it in, you'll be very flexible about it, right? So I would choose either this one, okay, or if I feel like price is not going to reach all the way up into this wick, I would use this one. So essentially what I am saying is, because now you know that I don't I'm not worried about small stop losses and all of that. So for me to guarantee the entry, right, to guarantee the entry, if I am faced with this scenario, my sell limit or my market execution will be here. Okay, and my stop loss will be here. Why here? Because for the bearish order block to be invalid, right? For the bearish order block to be invalid, it's going to trade through the 50% mark and then obviously stop me up. So from here above, that's your point of invalidation. From here below, that is a point in which the trade stays safe. Okay, that's the point in which the trade stays safe. All right, that's the point in which the trade stays safe. Do you guys understand? Do you guys feel me? Are you the feeling? Feel? Always feels? Very good. Okay, I'll take this out then. Actually, I'll just go down. Okay. Righto, final part. So I'm keeping this short, right? So final part would be incorporating order blocks with the IPDA delivery cycles. Oops. IPDA delivery cycle. So it should not wick through. No, it can wick through. It should not close to the 50%. Okay. Yeah. Wicking is possible, but not close. All right. Okay. Finally, after this, I'll tell you what your homework will be, right? By the way, did you guys do yesterday's homework, or obviously you guys still have to do it because you need to get 25 live examples as well, right? So next week, work on that. So today you have homework as well to incorporate today's teaching with yesterday's one. All right. Incorporating order blocks with the IPDA delivery cycles, right? We know that we have the reversal cycle, and then we have the continuation cycle, right? So continuation. So obviously, going through the advanced teachings for algorithmic trading, we know that this fellow here falls under the, before I finish drawing, falls under the 50% of a what? 50% to 75% of a. Someone going to help me out or what? Yes, 50% greater than above 50% of the GPS, right? With a GPS graded price wing. And this fellow over here is within the 0 to 25% mark, right? So here is the magic. right? This is the magic, right? So I'll take out the magic now. Let's look at the basics. So it's not about magic. Today is about the basic stuff. Okay, right. So now we understand that uh, the reversal cycle essentially works to initiate new order flow, right? Works to initiate new levels of order flow, right? By through SMT and whatnot. So if I just show you an easy example, so I'll use a bullish example. So we got consolidation, then we got expansion, then we got reversal, then we got retracement, and then what do we got? Reversal, and then what do we got? Consolidation. Okay. Now here's what I'm going to ask you. All right. Here's what I'm going to ask you. Break this down. Okay. Now let's say this is the 15-minute. Right. Then let's look at the H4. The H4. All right. On the 15-minute time frame, we can clearly see that this is the consolidation. We can see this is the expansion. This is the reversal, retracement, reversal, right? Now, from what you understood today at point number 1, point number 2, okay. What is point number 1? What is point number 1? No. In terms of candles, what is point number 1? Down close, okay. Down close. And then point number 2, what's the point number 2? Up close. Right? So obviously this up close needs to be big, or a series of up close candles, right? So now we understand that on the 15-minute you have a down close or a series of down close candles, and number 2 you have a series of up close candles. Okay, you have a series of up close candles. Then okay, now I'll ask you something else. Okay, now on the 15-minute time frame, if this cycle is visible like this, okay, if this cycle is visible like this, what does this portion of price, or what is this portion of price? On the 15-minute time frame, what is this portion of price, including this high? What is it? No, what's the name? In the PDA matrix, what's the name? PDA matrix, what's the name? On the 15-minute time frame, if this cycle is visible, what's the name of this in the PDA matrix? Anyone else want to give it another shot? What is the name of this? No, it is the breaker, right? So this, we have a low, low, and high low, and a high. Okay, we have the breaker. Okay, so on the 15-minute time frame, you have the bullish breaker. Now, on the 4-hour time frame, okay, on the 4-hour time frame, you're obviously not going to see this entire cycle like that. Now, this entire cycle over here, how is it seen on the 4-hour time frame? Someone tell me. How is this entire cycle seen on the 4-hour time frame? Don't give me all blocks, someone else. Give me candle by candle, because we see candles, right? So what are we seeing on the 4-hour time frame? No. First candle is not the up candle. Okay. We have a down, and then we have a up. Okay. We have a down, and then we have the up. Now, where are you going to be keeping your buy limit? Is your buy limit going to be at point number 1, or at point number 2. Now be smart with it, okay? Or in between. So you have 3 options, 1, 2, or in between. Which one? What about the rest? Okay, between, right? So you will want to keep it inside 1, 2, or in between, anywhere. And your stop is obviously going to be below the mean threshold. Okay, the stop is going to be below the mean threshold, right? So this is to account for deeper moves, shallow move, all of that, right? So to account for that, you can just keep it anywhere inside of this particular zone of price. While you know there's a precision element to it in terms of where it will exactly reverse from, right? As long as your stop is over here, it doesn't matter. Okay. At times it comes all the way down to the OB on 15. Yeah, when it comes all the way down to the OB on 15 minute, then that would be coming to the 50% mark. After the 50% mark, it's very sensitive. That's right. Okay. So to guarantee your entry, you would enter over here. If you want to be super precise, then of course you're going to have to wait and see and enter from here. Okay. So that's that. Right. Taking it out. Okay. So now you guys get this, right? Now that's the reversal cycle. And now to drive home the point of all of this, okay, we understand that the reversal cycle, okay, we understand that inside of the reversal cycle, we have the consolidation, expansion, reversal, retracement, reversal, right? So this is what it looks like on the lower time frame. On the higher time frame, it's just something like this. So this and that, this and that. All right, that's the reversal cycle. This is how it looks like. That's what you should understand. You, as a trader on the higher time frame, you need to focus on what's happening down here. Okay, because the story that you see over here, right, on the lower time frame is this entire story here. You understand that, okay, high resistance liquidity run. Okay, high resistance liquidity run. Price broke above. That means I can keep my buy here. I can keep my buy so over here to go up. Okay, to go up from there. That is the reversal cycle. Now, what about the continuation cycle? When you look at a continuation cycle, what is the signature in price? All right, what is the signature in price that we should be looking for on a continuation cycle? Someone can someone tell me? Signature in price for a okay. All right, so that's liquidity wise. What about cycle wise? No, what about the cycle wise? What should you see? What are the 4 or 5 stages of price that you need to see? Number 1 is no, no. Yes, Theo, consolidation. Then, okay. Then, retracement, reversal. Okay. Retracement, and then reversal. Good. Retracement and then reversal. And then again, the cycle boom goes all the way here, all the way back here. All the way here, all the way back here, right? So all these are tradable. Okay, you have to be smart with how you trade them. Okay, you have to be very smart with how you trade them. All right. And when price comes to this segment of the cycle, this is when your order blocks come into play. Okay, you draw them out in time, you get the levels ready, and then you buy or sell off of them. All right, you buy or sell off with them. So that is it. So that's all ICT month 1 stuff. Okay, so I'm not going to be going through that. So you guys know that, right? So retracement, reversal, that is where majority of your positions are going to be entered from. And obviously, if you enter inside the consolidation, right? Obviously you can get this as well, right? You can get that as well. So that would be it. That would be it. Now here's a question for you. Small trivia, and I'll give you the homework. You have the consolidated, you essentially you have the entire cycle, right? Now we understand that the cycle, is, how can I put this? The cycle has many expansions, right? It has ups and downs, big expansions, small expansions, some expansions that are tradable, right? Expansions that are tradable. So now someone tell me, for these expansions to happen, again, for these expansions to happen, it needs to happen in a certain way, right? So meaning that there should be some form of institutional accumulation happening, right? So in order to ensure that you are getting in the price move that is going to make an expansion, what should you be looking for in price? Michael is close, but I want an answer, not a question. Oh my God, no, very wrong, man. Ah, Eugenio got it right. Yes, we got the champion. So the champion today is Eutina. Eutina 90. Okay, it is SMT. You get the SMT, you get the real move. No, but you said it in the question, right? You asked me. Eutina told me. All right, so SMT is this one. Okay, so we have second place. Second place, you got Michael. iPad don't lie. Okay. All right, so SMT, right? SMT occurs. That's your real move, right? Yeah, it does. It does. Yeah. So SMT occurs. That's your real move. If SMT does not occur, then you're going to see some form of hanky panky happen in price. Okay, you're going to see some form of hanky panky happen in price. Now, what do I mean by hanky panky? All right, let's assume. Okay, let's assume. How can I put this? Let's assume. Let me think. How can I put this? Okay, let's use something that I trade. So here we have gold, and you have AUD USD. Okay, so now for a bullish expansion, you need gold and gold and AUD USD. You want gold to make, let's say, low, this guy to make a higher low. Okay, or this higher low, this one to make a lower low. All right. So when you see these happening only, that is when your buy immediately leads to an expansion up. Okay, immediately leads to an expansion up. Now, the extent to which it will expand, okay, to the extent to which it will expand is known as the SMT terminus. Okay, SMT terminus, which unfortunately for you all, it is off record. Okay, SMT terminus, which is off record, right? So now with knowing the SMT terminus, you know just exactly from from the point in which the SMT occurred, you will know exactly where price is going to expand to, and after that you will know when that when the retracement will occur, when the reversal will occur, when there will be an inducement, and when there won't be an inducement. Okay, so that's all taught inside of SMT terminus. All right, so that's all. Let me take you guys to the chart now. Let's look at Bitcoin, and then we can go. Will I teach it? Yes, I'll discuss it. Yes, I will teach it. I'll discuss it. All right. Okay, let me get the charts. Give me a second. How can I get my chart back now? New share screen 2. All right. All right. Okay. Okay. I'm going to stop recording. So officially, bye bye.